Hello, this is George, and this is yet another tutorial on Trading Simula 18. Last month I gave you a simple trading strategy, Michael Cavell's system that was demonstrated in his book, Trend Following. In this tutorial, I'm going to show you a little bit more advanced trend following system. This system is based off of a trading system that sold for thousands of dollars back in the 1990s. And I was also going to discuss that I have not yet released my latest version. It's going to be very soon. Since I published this video, the last video, I've added several bells and whistles I thought would be very beneficial into the platform. So it'll be another week or two before, maybe 3, before I release this version. If you do have my books and you would like to have this beta version, just email me and I'll send it to you. Like I said, it is a beta version. I'm not through 100% testing it, but if you want it, let me know. Today, we're going to learn how to program a simple system. Simple in the sense that it's easy to get in, but we're going to program multiple exits. Sorry about that. We're going to program multiple exit technology. So let's get down to it. And as you do this, you'll learn Python. So if you learn Trading Simula 18 from scratch, you'll not only learn Trading Simula 18 and its environment, but you'll also learn Python, simple Python, not the Python that you tie into NumPy or SciPy or any of those other ones, Matplotlib, just bare bones Python, which you need to know before you can start playing with those other libraries, or you should know. Anyways, we're going to do a little simple system. It's going to start with the Bollinger Band system. Like the Donchian, the Bollinger Band is one of the, I guess, the most popular, that and Donchian, and of course moving average crossover. But the Bollinger Band is probably the most popular, or close to being the most popular, trade entry technique for trend following systems. So this system's not going to, this strategy is not going to be any different. We're going to go long when the close crosses above the 80-day 2 standard deviation Bollinger Band. So that means yesterday's close has got to be below the Bollinger Band and today's got to be above the Bollinger Band. And if that happens, then you go ahead and take a long trade. Going short is just the opposite. You need to close above the band and then a close below the lower band of the Bollinger Band. This is where it gets a little sophisticated in the exit rules. What we're going to do is we're going to measure the distance between the 80-day moving average and the Bollinger Band, and we're going to divide that by 2, and we're going to store that information on a per market basis in a variable, the init trade risk per market. This variable is going to be market specific, so we have to index the variable with the current market, because I'm not calculating it on every bar. If I was calculating it on every bar, then we wouldn't need to worry about including the current market index. By using current market, we're saying this variable is different for each market, and it's not calculated on a daily basis, but every once in a while. So we're going to go ahead and do the same with set trail bars current market to 80. We're going to go ahead and use a trailing stop mechanism. And every time you enter a trade, you're going to use a moving average to exit the trade. And it's going to start at 80, just like a Bollinger Band. The midpoint of a Bollinger Band, 80-day Bollinger Band with 2 standard deviations is the moving average, which is 80 days. So here I go. I say, remember to use current market or CM. You can use either current market or CM as your variable index. For any value that is not calculated daily, these 2 variables, init trade risk and trail bars, are only calculated when the current market position is flat. We'll use these values later in the code. Okay, I'm not going to explain the short exit because it's basically the opposite of the long exit. So let's get into the long exit first. And then I'm going to show you how we program it. And then we can just flip it over for the short signals, short side. That's the beauty of trading, of programming trading systems. 9 out of 10 times, the short entry is just a mirror image of the long entry, and you just can copy and paste and make some modifications. I like to start with one of my templates that I provide. In this one, this strategy is going to incorporate a market order and also a stop order. So let's get into the long exits. We're going to have a break-even exit. If the max trade profit exceeds the net trade risk, and we calculated that as the distance between the upper Bollinger Band or lower Bollinger Band and the moving average divided by 2. If the max trade profit exceeds the net trade risk and the market retraces all the way back and closes below the entry price, they want to exit the next day at open. That's basically saying, okay, I had a nice profit. I've given it all back. I don't want to turn this nice profit into a big loser. Worst case scenario, I want it to be a small loser. So that's a break-even exit. We're going to have a big win exit. If open trade equity is greater than 10 times the average true range of the past 20 days, then we want to exit at the next day's open. And that's good because it's not a pure dollar profit objective. It's based off the current market condition, which is the average true range. So if you're in a compressed market, that amount of movement is going to be less. If you're in a non-compressed market or a market that's got a lot of volatility, that number will be larger. So you're hoping that the big win exit will get you out with enough profit based on the current market condition. Okay, we're going to have a trailing exit. We're going to start at 80-day moving average and decrease the moving average. I need to highlight this when I'm talking. Sorry about that, guys. Start at the 80-day moving average and decrease the moving average 1 day for each day a long position is on. If the market closes below the moving average that you've calculated based on the trailing bars, then we exit next day at market. Do not go below a 20-day moving average. Okay, so we start at 80. If we're in the trade, 1 day it goes to 79, 2 days 78, 3, 77, 76, 75, and we work our way all the way down to 20, but we do not go below the floor of 20 days. So if you've been in a trade for, what is that, 60 days, and you're still in the trade, there's a good chance you're making a good profit. So you don't want your exit to be that close. So a 20-day moving average is where I chose to stick that exit. We're going to have a disaster stop. We're going to place an order to exit on a stop at entry price minus the net trade risk. Remember, the net trade risk is the difference between the Bollinger Band and the moving average divided by 2. Later on in other tutorials, I want to talk about some advanced topics. I want to utilize sector allocation. I want to do a limit 2 positions at most per sector, and we'll do a sector breakdown. But that's for another video. So let's get into Trading Simula 18 and get this thing programmed. Okay, we're going to start at the top. Say change system name. I'm going to go from 2000 January 1st through whatever date I have, whatever data I have. Bunch of 9s. Ramp up 200. We don't need 200, but I always start at 200. Let's call this Bollinger Band BB with exits version 1. The net capital is going to be 100,000. We will not be utilizing that in this video, but we will in the subsequent video, and the commission slippage will be set at $50. We're not going to be using any of these indicators, these class-based indicators. In future videos, I will, and I'll show you how to access them using what I call the Use Easy Indicator classes. That makes easy, if you want to do it. It's so easy and easy language to access the RSI, the ADX, whatever. You just call a function and it returns the value. Then you can index into that and say, what was the ADX 5 or 6 days ago? And I'm going to show you how to do that in Trading Simula 18 very soon. Okay, we're not going to do any money management. We're going to keep that to a minimum. And we can keep, this has all to do, well, no, these have things to do with the sector analysis and the position sizing. We will not talk about those today. We're going to talk about a net trade risk, and we're going to talk about trail bars. Remember, these are variables that are specific to each market, so we have to define them as a market val 1 or market val 2, and those are built in lists. that will keep track of the variable on a per market basis. So we need to set them to market val 1, market val 2, and I think I go up to market val 10. And I also have a function that you can call if you want to create your own, or you need more bar, what I call bar lists. Some people will call them a bar array. In easy language, every variable that you declare is what I call a bar array. It has a history, and you can index that history. And so that's what market val 1 and market val 2 does. It allows you to look at the, not necessarily the history, but what was the value of init trade risk for corn? What is it for soybeans? Things like that. Okay, so we need to talk about those two variables, which we have. Let's talk about the market risk mult. That's something that the system you can optimize if you wanted to. You can change that. I'll talk about what that variable is used for. The big win mult we discussed, we've got it set at 10. That's 10 times the average true range. If you get that type of profit, take it. Number of days to increment the trailing stop once you're in a position is set to 1. Entry day trade risk is 0. May not need that. I have to think about that. Are we going to use money management? In this case, it's false. We're not going to use it. If we were, I'll show you something real quick, which is cool with PyScripter and many of the IDEs out there that allow code collapsing. Here's a bunch of code that you don't see it. It's in a region. And you can tell because it's got ... But if I were to expand that, there's a bunch of money management code. But you can easily collapse that so it keeps you distracted. It keeps you from being distracted when you're doing your initial programming. Okay, so what do we need for a Bollinger Band? Well, we need the upper band, and we need the lower band, and we need the average. So all we got to do is call B bands, which is my function call for Bollinger Bands, and you'd have to know what that is. And I have a wiki that I'm working on, and it is posted on the website. It's not complete yet, but it's getting very close to being done. And I do discuss Bollinger Bands and how you call them and assign the values from the output of that function. In Python, which is really cool, is a function can return any number of values. Like in Bollinger Bands, in TradeStation, you'd have to create a numeric ref to get more than one return from a function. And as a reference to the location in memory. We used to call those subroutines versus functions. But with Python, functions and subroutines are basically the same thing. So here I can return 3 values from a simple function call. I'm going to return the upper band, the lower band, and the average from this function. My trade risk is going to be equal to the upper band minus the average divided by 2. Now you might ask, why did I use upper band or instead of using lower band? Well, it doesn't matter. They're the same. They're equidistant from the moving average. So they're going to be equal to the same. So my trade risk is the upper band minus the average divided by 2. If I'm in a flat position, MP, remember MP is a market position. MP, market position. I'm going to set my net trade risk of the current market. Remember, we need to, since we're spanning the portfolio on a daily basis, we go from euro currency to bonds to corn to silver to gold on the same day. So we're leapfrogging from one market to the other. So we have to keep track of each market, and the current market is the index that does that. So if I'm flat, my net trade risk, current market, is going to be equal to trade risk. If I'm flat, I'm going to set my initial trail bars per market, current market, to 80. Here we're also going to trade a position size of 1. I got a print statement there. Let's go ahead and knock that out real quick. I don't need that. And that's all we need, really. That's all the calculations this system really needs to start with your entry and exit exit technology. The entry technology is simple. If I'm not long, MP not equal to, that's not equal in Python. if I'm not long and crosses my close above the upper band, and I want to say 1 is above, crosses above, and D1 means start with yesterday's data and go back another day. So because we're looking at yesterday's close and the prior day's close in relationship to that upper Bollinger Band. If there is a crossing, I'm going to set my price to open of the day, open D, and you could use D1, D2, D3. That's 2, 3, 4 days ago. I'm going to give it a trade name, long entry, and then I'm going to append my trade ticket. And this is important. You need to understand how to do this. And of course, everything in Trading Simula is based off of a template that already exists. So you don't have to remember how to do this. You just need to open up an existing template, change it to something you want, the name, and then start going in and making your modifications. So I'm going to go ahead and say trade ticket. It was there already because this was based off of a market template that I had. It's a buy order. I'm going to put the trade name there. I'm going to put position size there. Put the price, which is the open of the day. And this is going to be a market order, MKT. That's market. And as you need to be careful when you're using your brackets and your parentheses. The trade ticket is a list. And it's a list of lists, basically. So the first item in a trade ticket is this information here. So I'm gonna gather all the trade tickets up, and then at the end of the day, or during the day, I should say, I'm gonna go ahead and process whichever order is closer. And in TradeStation's easy language, you could say buy today at the highest high of the past 20 days, and also buy at the Bollinger Band of 80 days and 2 standard deviations. You could place both those orders. And easy language in TradeStation is smart enough to parse that and determine whichever market or whichever order is closer, it will take that order first. If you have pyramiding turn on, it will take both orders. Okay, basically that's it for the long entry. Short entry is just the opposite. If I'm not equal to short and crosses below, the close crosses below the lower band, I'll go ahead and put on a short position. Now here's where it gets a little bit more hairy. We have 4 exits. Long exit 4, this is the continuation of it. So let's go over these real quick. They do look, you may think they look a little complicated, but a lot of the code is just setting the price and the trade name. So it's not that much code. If I'm long, which is MP equals 1, in this case, since we're doing one contract on a per entry basis, we could say 1. If we were doing multiple contracts, you would probably want to say greater than 1, or greater than 0, I should say. If I'm long and max contract profit divide by my BPV, and I've done this, you can do this here. I'm making it look like easy language as best I can. If max contract profit, this is a built-in variable and it's in the wiki and the manual, divided by the big point value. So this is going to be a dollar value. And once I divide a dollar value by the big point value, it gives me a price range. If it's greater than the init trade risk of the current market, we'll always remember the current market. That's key. That's the key thing to Trading Simula 18. To remember, we're hopping from market to market to market. You need to keep the variables, if they're not calculated daily, you need to store them in a list and index it by current market. Okay, and my close of D1, which is yesterday, is less than entry price, and bar since entry is greater than 1, that means that I want to get out on a break-even exit. I've had a nice profit. The market's come all the way back down. I mean, I'm long and my close of yesterday is less than my entry price, and I've been in the trade more than 1 day. I'm going to get out on a long exit break even. So what we do is we set the price, we set the trade name, and we append the trade ticket to include exit long, trade name, the current shares, because I want to liquidate the entire current shares. If I was doing more than one, and current shares is the same as current contracts. Say we're doing 25 and I wanted to scale out of 10, I would specify not current shares, but 10 here. So I need the price, and this is as well as going to be a market order. That's long exit 1. Long exit 2 is the big winner. If I'm long, MP equals 1, and the close of yesterday minus entry price is greater than the big win mult, which is 10, times the average true range of the past 20 days, and I've been in the trade more than 1 day, I'm going to get out in the open. That's a big winning trade. So that's what you're hoping for, to hit as many of those as you possibly can without giving up too much money on the table. If it's too tight, then you're bound to lose, and you can lose taking profits. They say you can't ever lose taking profits, but you can, because you need to make sure your profits exceed your losses. And if we're going to limit our profits, we better make sure they're big enough to cover our losses. Here's exit 3. If I'm long, my trail bars, and remember it's on market basis, trail bars current market equals trail bars, the prior value of trail bars minus the increment. So we start at 80. So 80 equals, well, this will be new, so we can't say that. This will be equal to 80 minus the number of days trail inc, which is 1. So trail bars, which is now 79 on the second day of trading of a position, we had to compare that to the floor, and I may not need to use floor there. I think I did that to round it to an integer. I want to take the max of trail bars, in this case it's 79, or 20. Now if I get down to like 9 trail bars becomes 19, I'm going to move it back up to 20. I don't want to go below a 20-day moving average to exit the position. So my trail exit is going to be equal to the moving average, S average, which is simple average, of my closing prices, whatever trail bars current market is at this point, because we're decrementing it, and it's on a current market basis or per market basis, the current market offset by 1. This trail exit is going to be assigned to L exit 3 level. And that really should be, I guess it should be along exit 3. Sorry about that. So a typo. This is a continuation of long exit 3. This is the calculation of the trailing exit, and this is the execution of that trailing exit. If I'm long and the close of yesterday, D1, is less than long exit 3 level, which we just defined there, we're going to go ahead and get out at the open. Price equals open, trade name equals L exit trail. We're going to pin the trade ticket with an exit long. It's always good to give your trade names, your signals, good trade names. We did long entry, which pretty simple. Long exit break even, BE. Long exit big winner, BW. And here's going to be long exit trail. And then we're going to discuss the last exit technique. If we're long and bar sense entry is greater than 1, we've been in the trade more than 1 day, I'm going to go ahead and say trade name is equal to long exit MM. We don't know if this order will be executed. We're just going to go ahead and issue it because it is a disaster stop, and we want to place it every day because if we don't get out at the open, we want to be able to get out on this on an intraday basis. So my trade name is L exit MM. The price is going to be equal to the entry price minus the initial trade risk. Whatever, when we came into the trade, whatever that risk was, we're going to use that as a disaster stop. So that's what my price is going to be equal to. Now, in Python and many other programming languages, when you do a simple addition or subtraction, sometimes you get these values with like you get, say it's, I don't know, it's crude oil and it's $100 a barrel. You might get 99.9999999. So what I do is I round it up or down to the nearest tick. I want an actual price. So that's what I'm doing with the price equals round to nearest tick. The price, I want to round it down, big point value. That is not right. That should be, I don't know why I put big point value there. That should be my min move. Let's get it right. Let's make sure, let's go down here and change it down here. I'm sure I did it down here as well. Sorry about that. Round to the nearest tick, it's my min move. Because my min move is min tick. Okay, sorry about those two typos. So that is the stop that we're going to issue if we're long, the disaster stop. So we're going to append the trade ticket yet again. We're going to exit long, trade name, current shares, price, but we're getting out on a stop order, STP, stop. Limit order is LMT. That's it's Lima Mary Tango. The short entry is exactly the same, except it's the mirror image. I shouldn't say exactly the same, should I? The short entry is the mirror image, but we're going short, and so you have to flip usually the greater signs and to less than signs and things like that, and test for the current market position. So let's go ahead and run this. And again, I am using PyScripter that has collapsible text. It's one of the best IDEs I've come across. It's simple, super simple to use. And I think if you like idle, which comes for free, this is free as well. You just give them a little bit of, a little contribution to help them keep their development going. It's like I said, it makes everything super easy. So we're going to run this, and everything's going to appear down here in the bottom. This is the Python interpreter. This, like I said, is just a real quick snapshot of your performance. And of course, you can delve deeper into the reports. And as you know, I provide like 20 reports for each test. So let's go ahead and run this. Okay, this is running. Here are the different portfolios. That's currencies. That is energies. Sorry about that. Energies, metals, grains, financials, exotics, and meats. So that's the portfolio I'm going to run. And like I said, it loads up all the data first into memory, and it starts working on a per bar basis for each market. So it's doing a lot of work in the background. Is it kind of slow? Yeah, it is a little bit, but when you're doing trend following systems, quickness is not that important. No, quickness when backtesting shouldn't be that important, because you need to really concentrate on what you're doing. And if you're running a bunch of tests and you need that speed, you're probably over curve fitting. So speed is not that important when it comes to backtesting, because you're not in a hurry to put your system into the market until you know it's a good system. It's a robust system. So let's see what this system did. These are all the sectors. I'll give you how they've done in the past 4 years. Little text-based graphics there. We'll just ignore that right now. We'll just go to the numbers. Okay. There they are. The total profit is 682,000. We had a pretty steep drawdown of 189,000. So that's what, almost 1-to-4 ratio. More like 3 maybe. 3, yeah. That's not bad for a trend following system, to be honest with you. We had that drawdown when we had it, and timing of a max drawdown is so important. Right off the bat, it usually knocks you out of the game. If you have it, 4 or 5 years down the road, then you can bear that drawdown because you've got enough profit. And at the time we had that max drawdown, it was only 22.5% of our equity at that point, meaning that we had 5 times that. Basically, we had $700,000 in profit before that happened. Maybe not 7. Let's see, 5, 9. 900,000, something like that, maybe less. And we had that 22.5% drawdown, which you could stomach, you know. I mean, again, max drawdowns timing is what either keeps you in the game or knocks you out. You always want that max drawdown to be later in the equity curve. As many people have said, your max drawdown is always ahead of you, and that is absolutely true. You just hope that when that drawdown does occur, you've accumulated enough profit to be able to endure it. On an annual basis, you could expect a drawdown of $60,000, and we had 2,086 total trades. This is without money management. Let's take a real quick look, and we'll be done. Let's take a look at the equity curve. Let's go. We don't want equity. Let's look at combined first. There's the combined equity curve. And if you've read my blogs, you know that is a very, I mean, that is the equity curve of trend following systems. This one's not too bad because it does have some pullbacks, see them, but they're not that deep. I know 22% is pretty steep, and it would cause any money manager to start rethinking his trading approach. But we've always had these drawdowns, but they've bounced back, and here we are again in that drawdown. And this is in 2023. So that is the trading system, and I'm going to talk to you more, not in this video. I'm going to try to keep this, I know it's getting long, but here is some of the topics I want to cover to just show you how powerful this Trading Simula 18 is. We did our first test. Right there it is. That's about the same. I think I made one modification, so this might be a little dated, but it's pretty close. Yeah, 682. And that's going to be no sector limitation, one contract basis. Then I'm going to do a limit 2 positions per sector basis, meaning that you can only enter, I think there were 4 sectors, or 3 or 4 sectors that had more than 2 markets in those sectors. So we're going to take the first 2 trades, and then we're going to ignore the subsequent trades if we have 2 positions on in that sector. And I'm going to show you how to do that in the next video. And then I'm going to show you how you can prioritize which markets you take those 2 sectors first, which market in those 2 sectors you want to take first. And then I'm going to show you how to do a fixed fractional approach with no sector limitations. It gets crazy. It's some huge numbers. And then I'm going to show you a fixed fractional, no sector limitation. And what we're going to do is we're going to remove 80% of the profit at the end of each year, meaning that if I make $100,000, I'm going to take $80,000 away from the amount of money I'm allocating in this next year to the position size. And here are my adjustments, annual adjustments. If I don't make money, I make no adjustment. If I lose money, I don't make adjustment. If I make a little bit of money, I'll take 80% of that out of the kit to diminish the position size by 80%. And then I'm going to show you how, which is really a cool feature, how you can, with Trading Simula 18, on an annual basis, at the beginning of each year, when you do recalculate or rebalance, you can go in there and say, hey, I'm trading, let's see here, I'm trading, this is a good example here, I'm trading 41 crude oil, and again, this is fixed fractional 2%, so these are crazy numbers. I'm trading 41 contracts of crude oil, which that's a lot of crude. You'd have to be huge, well, somewhat huge of a money manager to be trading that position size. But because I had a big profit the prior year, I'm going to take 80% of that profit out, and I'm going to recalculate the number of contracts I should be trading. In this case, I should go from 41 to 21, and to do so, I need to immediately liquidate 20 contracts of crude oil. Okay, so we get back into a normal size position based on how much money we made or lost the prior year. But like I said, that will be a little down the road, and in the next couple of weeks I will put those videos up. Okay, I hope you enjoyed it, and I hope you learned something. And if you have any questions, email me at georgepruitt@gmail.com or george.p.pruitt@gmail.com. Either one works. I appreciate your attention and look forward to the next couple of tutorial videos.